When I was younger, I made one mistake again and again. I thought the most dangerous market was the market that looked dangerous. I thought the real risk would arrive with red screens, panic on television, and a chart so ugly that even the optimists would finally go quiet. That is not how most people really get hurt. Most people get hurt when the market looks almost invincible. They get hurt when the index is printing all-time highs, Bitcoin is running, dividend funds look steady, and the financial world starts acting as if conflict, inflation, debt, and speculation can all be ignored because price has temporarily stopped arguing. That is where discipline matters most. And right now, that is exactly where I believe we are. The S&P 500 is touching fresh highs. Crypto is running hard again. Dividend products that people use as a kind of emotional comfort blanket are quietly performing well enough to make everyone feel clever. Meanwhile, the underlying world has not suddenly become clean, simple, stable, or cheap. The Strait of Hormuz is technically open, but the whole region is still unstable. The war premium has not disappeared. It has just become harder for ordinary people to see. Inflation pressure is still sitting there in the background. Federal Reserve policy is still uncertain. And the broad public is behaving exactly the way crowds always behave when prices rise faster than caution. They start believing the market itself is proof that the danger is past. That is when I slow down and look harder, because the market can do something very deceptive. It can rally at precisely the moment when the seeds of the next drawdown are being planted underneath it. That is the core idea I want to walk through today. Not because I think you need to panic, not because I think you should dump everything and hide in cash, and certainly not because I think every rally is fake. I am saying something much more useful than that. I am saying this is the kind of environment where gamblers get confused with geniuses right before the bill arrives. And if you do not want to be the one paying that bill, you need to understand the structure of what is happening now. When I look at this market, the main line I see is not strength. It is disguise. This is a market wearing a costume. It looks calm. It looks modern. It looks brilliant. It looks as though innovation is winning, caution is outdated, and discipline is just an old man S-word for missing out. But when I look underneath, I see something else. I see the same emotional machinery that showed up before one of the largest wealth destructions in market history. I see people buying stories because the stories are moving. I see platforms making it easier for inexperienced traders to behave like institutions without any of the institutional training, discipline, or risk controls. I see an economy still exposed to war, driven cost pressure, while investors behave as if earnings will glide right over it. And I see a generation of people who have been taught by the last decade that every dip must be bought instantly. Every new technology deserves immediate premium pricing, and every all-time high is proof that the crowd must already be right. That combination is how wealth gets redistributed from the excited to the prepared. If I were to put one phrase over the entire environment, it would be this: do not be fooled by the costume. The first place I want to start is with the part of the story that should make any serious investor uncomfortable, because it tells you how fragile crowd behavior can become once a technology narrative starts replacing valuation. In the late 1090s, investors were not wrong that the internet would change the world. They were wrong about time, they were wrong about price, and they were wrong about how many businesses deserved to survive long enough to monetize the revolution everyone could suddenly see. That distinction matters. The internet was real. The euphoria was real too. Those are not the same thing. A real technological shift can still produce a fake market. That is what people forget. They remember the winners. They forget the valuation insanity, the rubbish businesses, the name changes, the fake pivots, the sloppy capital allocation, and the simple emotional truth that people were not buying future cash flows. They were buying motion. They were buying social proof. They were buying the feeling of not being left behind. That is the definition of FOMO. And FOMO has never once improved the quality of an investment. It only improves the speed with which crowds overpay. Back then, all a company had to do was make itself sound like an internet company. A name changed, a press release appeared, and suddenly investors behaved as though profits had already arrived, even when the business itself had barely changed at all. That is one of the purest market warnings you can ever get. When the label becomes more valuable than the underlying economics, the crowd is no longer allocating capital. It is auditioning for pain. That is why what happened this week matters so much to me. A shoe company decides it is now going to pivot into artificial intelligence, and the market responds as if a miracle has occurred. The business did not suddenly become better, because the language became more fashionable. The cash flows did not transform because the label did. The economics did not improve by hundreds of percent in a day. Only the costume changed, and that was enough to pull millions of dollars into the stock. If you are an investor and that does not bother you, it should, because that is not a sign of healthy price discovery. That is a sign that the market is rewarding association more than achievement. And whenever that starts happening, I think of the late 1990s immediately. Not because history repeats with perfect elegance. It does not. It rhymes through psychology. That is what repeats. A new technology appears. The true believers are partly right about the long-term impact. The crowd then takes that valid long-term idea and drags it into the present as justification for nearly any valuation, any business model, any pivot, any name change, and any degree of stupidity. Then the market eventually remembers that even real revolutions are not worth every price. That is where the pain begins. Artificial intelligence is real. It will change the world. It is already changing the world. That still does not mean every company with AI and a slide deck deserves a premium, as if the future has already arrived and been flawlessly monetized. That is the first red flag. The second red flag is, in some ways, even more dangerous because it changes market plumbing. We are now making it easier for smaller and less experienced investors to day trade aggressively, without the kind of capital threshold that at least created some friction. Before, I know there are people who hear that and say, good democratization. I hear something else. I hear a business model where platforms get richer the more often undertrained people confuse activity with skill. Robinhood and WeBull do not need you to win. They need you to trade. That is an entirely different incentive. This is one of the simplest truths in finance, and it gets ignored every cycle because people want to believe access is the same thing as advantage. It is not. If you remove barriers and replace them with risk-based margin rules in an environment already full of volatility, narrative chasing, AI fever, crypto excitement, and social media fueled imitation, you do not create a generation of disciplined allocators. You create faster churn. You create more emotional entries. You create more people who can now damage themselves at high speed while believing the system has empowered them. Again, none of this is theoretical. The platforms benefit because more activity means more revenue. The user feels more capable because the rules say he is now allowed. The market becomes more fragile because more participants are trading without the capital cushion or emotional experience required to survive the obvious drawdowns that come later. I have watched enough retail trading booms to know the pattern. People call it freedom on the way up. They call it manipulation on the way down. And the whole time the platform took its cut. That's what this matters is not just a policy change. It is an invitation to over-participate at exactly the wrong emotional moment. So now, step back for a second. A market is at all-time highs. A speculative technology narrative is strong enough to turn a shoe company into an AI darling for a day. Trading platforms are making it easier for smaller accounts to act with more leverage and less restraint. And this is happening while the underlying macro picture is not clean at all. That combination should make you more cautious, not more euphoric. Now, I want to talk about the macro side because this is where people start fooling themselves with price action. They look at a rally and assume the economy underneath must be getting safer. Sometimes that is true, often it is not. The Strait of Hormuz is the perfect example of how people misread a market relief move. Yes, it is open. Yes, that helped calm immediate panic. Yes, oil pulled back from the worst levels. But an unstable choke point does not become irrelevant because it avoided maximum disaster for a few days. The market wants a clean narrative. The real world is not offering one. The war premium is still there. The military presence is still there. The conflict architecture is still there. Even if the shipping lane stays formally open, uncertainty itself has a cost. Businesses do not wait for total closure before repricing risk. Insurance reprices, transport reprices, energy assumptions change, supply chains react, financing decisions adjust, and eventually all of that reaches earnings. That is the part the market is pretending it can glide past. Maybe it can for a while. Markets can ignore a great deal temporarily. But the bill is still working through the system. War-driven inflation is not only about today's oil price, quote on a screen, it is also about what the replacement costs, logistics costs, and future government spending implications do to the broader economy later. At some point, what has been spent has to be replenished. At some point, financing conditions matter. At some point, margins get squeezed. At some point, the same crowd that bought, because the headlines felt calmer, starts realizing the income statement did not receive the same memo. That is why I do not trust a calm week. A calm week is just a week. The market is not investing in a week. It is discounting a future stream of cash flows under uncertain monetary and geopolitical conditions. And those conditions are still messy. Then we come to earnings. This is where the costume either holds or starts tearing. When the biggest companies in the market report, especially the giant technology complex carrying so much of the index psychology, the question is not whether AI is exciting. Of course it is. The question is whether the earnings are growing fast enough, clean enough, and sustainably enough to justify what investors are already paying today. That is where serious money separates itself from crowd money. A serious investor can love an innovation and still refuse to overpay for the stock. An unserious investor thinks loving the story is the same thing as owning a good investment. It is not. The internet was real, Amazon was real, the crash was real too. Too early and too expensive can be just as dangerous as simply being wrong. That is what I want people to understand before late. April earnings really begin shaping the next leg in sentiment. It is entirely possible that some of these companies are genuine long-term winners. It is also entirely possible that their stocks are too crowded, too expensive, or too dependent on expectations that leave no room for ordinary disappointment. The public often acts as if there are only two options. Either the technology is fake or the valuation is justified. That is childish thinking. Real life gives you a third option all the time. The technology is real, but the market price still got ahead of itself. That is the danger now. Now let me turn to what I would actually do with money in an environment like this. Whenever I see costume markets, I go back to something very plain. I do not prepare for what I hope happens. I prepare for what would hurt if I am wrong. That is the whole game. I am not trying to predict every twist. I am trying to make sure I do not become a forced seller inside a bad sequence. That is why I always sound boring right before the market gives people a reason to wish they had listened to the boring part. Emergency funds are boring. Debt payoff is boring. Not concentrating your life in one fragile job or one glamorous stock is boring, but boring is what keeps you from having to sell great assets at terrible prices because some other part of your life broke first. That is what people fail to understand about bear markets and corrections. The worst case scenario is not simply that stocks go down. The worst case scenario is that stocks go down. Inflation stays hot enough to pressure living costs, the labor market softens, and you personally lose income while your portfolio is already down. Now you are not investing, now you are liquidating. And liquidation under pressure is where long-term wealth plans go to die. That is why my advice always starts before the stock market. Have cash reserves. Not because I think cash is the best long-term asset. It is not. But because cash is what gives you time, and time is what stops volatility from becoming catastrophe. Pay off high-interest debt. Not because it sounds conservative and morally neat, but because debt is the enemy of optionality. When the bank wants its payment, it does not care that your favorite ETF is down 24%. It does not care that the market will probably recover in 3 years. It wants its money on schedule. If you carry that kind of debt into a fragile environment, you are voluntarily reducing your own future flexibility. I have never met a person who regretted entering a dangerous market environment with more liquidity, less bad debt, and fewer forced obligations. I have met many who regretted the opposite. Once that base is handled, then I go to investing, and here I remain as consistent as ever. I still believe the broad American equity market, owned through low-cost diversified funds, remains one of the most powerful long-term wealth-building machines ever created. I am not abandoning that because some shoe company put AI in a press release. I am not abandoning that because the S&P 500 printed a new high into a messy backdrop. I am not abandoning that because the crowd has gotten silly, broad index ownership through disciplined dollar. Cost averaging is still, for most people, the right core strategy, rain or shine, bull or bear, highs or lows. What changes is not a core strategy. What changes is the mindset around it. In a costume market, I want less greed, not less discipline. I want more patience, not more excitement. I want stronger foundations, not louder opinions. This is the part younger investors often misunderstand. They think caution means selling everything. Number caution means refusing to confuse a speculative atmosphere with a stable one. It means refusing to lever yourself emotionally or financially into a market simply because the tape is strong this week. It means buying steadily without worshiping momentum. It means knowing that broad market indices can continue making highs over time while large pockets of speculation inside them still become very dangerous. It means understanding that a long-term bull case for America is perfectly compatible with a short-term warning against FOMO. Those are not contradictions. That is maturity. Let me say something even plainer. The market does not care whether your entry was emotionally satisfying. It only cares about the price you paid, the risk you took, your ability to hold through pain, and whether the underlying asset compounder is real. That is why I keep repeating the same line, just in different clothes. Disciplined investors get rich. In markets like this, gamblers get exposed. The disciplined investor says, I will build my emergency cushion, reduce bad debt, and keep buying broad productive assets over time while keeping my position sizing sane. The gambler says, everything is going up. That means danger must be gone. Let me chase the hottest story with the weakest risk controls. The disciplined investor survives the scenario where the rally is real and the scenario where the rally is a trap. The gambler only survives one, and that is the difference between a strategy and a mood. So what do I believe is actually happening here? I believe the market is giving people a false sense of cleanliness. I believe AI is real, but is now attracting the kind of reflexive label, base speculation that always appears when a valid innovation becomes a crowd religion. I believe the changes in retail trading access will increase participation and platform profits, but will also increase the number of ordinary people who blow themselves up with speed they do not understand. I believe the geopolitical backdrop is less resolved than the price action suggests. I believe earnings over the coming weeks will matter more than the public currently appreciates. And I believe the right response is neither panic nor blind optimism. It is disciplined suspicion. That is the phrase, disciplined suspicion. Not cynical paralysis, not heroic confidence, disciplined suspicion. I suspect the costume, I suspect the crowd, I suspect the easy narrative, I suspect every market that starts acting as though risk vanished simply because price rose faster than fear, and then I act accordingly. I keep my life liquid enough to survive a hit. I keep my investing process simple enough to repeat. I keep my exposure broad enough that I do not need to correctly identify every future winner. And I keep my emotions calm enough that I do not turn temporary euphoria into permanent damage. That is how you stay rich once you have spent years trying to get there. Now let me close with the part I care about most. There is always a temptation in markets like this to think the only people who win are the ones who get aggressive first. That is wrong. The people who last are usually the ones who are hardest to force out. That means they protected their cash runway. That means they reduced their fragility. That means they invested in quality instead of motion. That means they kept buying. But they did not start worshiping the market because it made them feel briefly invincible. The market can make you feel smart at exactly the moment it is testing whether you deserve to stay. And right now, that is what I think is happening. This market is testing discipline. It is testing memory. It is testing whether investors remember that the most expensive mistakes are often made at the moment when everything appears to be working. So if you remember one thing from me, remember this. Do not be fooled by a market in costume. All-time highs are not proof that danger is gone. A rally is not proof that speculation is healthy. And a calm week in price is not proof that the structure underneath has been repaired. In moments like this, your job is not to predict perfectly. Your job is to stay prepared, stay solvent, stay broad, and stay disciplined long enough for the truth to separate itself from the costume. And the truth always does.